Picture this, right? It is late October. You are sitting in this like slightly stuffy board meeting for a local not-for-profit that you just care deeply about.
Oh, yeah. We have all been in that exact room.
You know the one. You have given them your evenings, your weekends. But today, the auditor has just delivered their report on the last financial year, and the mood in the room has just completely shifted.
You can cut the tension with a knife.
Literally. So the auditor clears their throat and mentions there are, quote, matters to discuss. They hand over this thick management letter, and then they drop the bomb. They say there is a qualification on the audit.
Right. And it is just a devastating moment for a room full of volunteers. I mean, the treasurer is probably just staring at their hands.
Yeah.
And inevitably, someone leans forward and asks, like, how did we let it get to this? We are volunteers. We thought things were fine.
Okay, before we go any further, let's unpack the jargon. Because, if I hear I have a qualified audit, my first thought is, great, I'm qualified. Like, I passed the test.
I know, right?
I am guessing in accounting terms that is absolutely not what that means.
Not at all. It is honestly one of the most counterintuitive terms in all of finance. If you want a clean bill of health, you actually want an unqualified audit.
Unqualified is good. Got it.
Right. Unqualified means the auditor has zero reservations. A qualified audit, though, means they're waving a massive yellow flag. They're saying the accounts are generally okay, except for this one specific area where we just cannot verify the numbers.
Oh.
And that management letter you mentioned, that is essentially a sternly worded warning list of all the internal weaknesses the auditor found along the way.
Okay, so a qualified audit is essentially a yes but from the auditor. And that actually brings us to our mission today. We are taking a deep dive into an incredibly insightful briefing we got from Trinity Accounting Practice.
Yes, it is a fascinating read.
It's titled Why Your NFP Audit Fails. And the single most surprising takeaway from this source, for me at least, is that these audits almost never fail because of some grand conspiracy or, a villain in the back room embezzling funds.
Exactly. When we look at the actual data, it is so much more mundane than that. They fail due to what the briefing calls governance gaps.
Governance gaps.
Yeah, just small, accumulated, almost invisible administrative weaknesses that just compound over time.
Which is exactly why this matters so much to you listening right now. If you are on a board or if you run a small business, or honestly, if you are just fascinated by how well-meaning people build flawed systems, this deep dive is just a masterclass in organizational psychology.
It really is.
Because the hard truth is, caring passionately about a cause does not automatically make your accounting systems robust. So, okay, let's unpack this. What does a governance gap actually look like in practice?
Well, at its core, a governance gap is just a missing link in your chain of accountability. What happens when an organization's habits haven't caught up with its reality.
Makes sense.
And the most dangerous gap of all, like the very first trap that Trinity Accounting outlines, is that before an organization can even fail an audit, it has to realize it actually needs one.
Right. Because a charity doesn't just wake up one morning and decide, hey, let's invite an auditor in to tear apart our books for fun.
Nobody does that.
It's legally mandated, and the briefing calls this trap size creep, which sounds incredibly ominous. Let's explore the trigger here.
So in Australia, the Australian Charities and Not-for-Profits Commission, the ACNC, sets very specific reporting obligations based entirely on the charity's size.
Okay.
And size is defined purely by your annual revenue. According to the source, and just noting that these are the rules current as of June 2026, there are 3 distinct tiers.
Right.
The first is small charities. This is an organization with an annual revenue under $500,000.
Okay, $500,000. I mean, that is a decent chunk of change for a local group.
It is, definitely. But under the ACNC rules, a small charity does not require a formal financial review or an audit. And crucially, they can choose to use either cash or accrual accounting.
I'll be honest, my eyes always glaze over when I hear the word accrual.
Most people's do.
Like, if I'm a volunteer running a local sports club, why do I care about cash versus accrual?
Well, it is a fundamental difference in how you view reality.
Mm-hmm.
Cash accounting is simple. You just look at your bank account, money comes in, you record it. Money goes out, you record it.
Like a normal checking account.
Exactly.
Yeah.
Accrual accounting, though, is much more complex. You have to record revenue when it is earned, not just when the cash actually hits the bank.
Can you give me an example of how that trips people up?
Sure. Let's say a government department gives you a $100,000 grant in December, right? And it's to run a youth program in March.
Okay, awesome. We got funded.
Right. Under cash accounting, you say, great, we made $100,000 in December.
Time to celebrate.
Exactly. But under accrual accounting, you haven't technically earned that money until you actually run the program in March.
Mm.
So in December, that money is recorded as a liability.
Wait, really? A liability?
Yeah. It's technically money you owe back if you don't deliver the program.
Oh, wow. That is a massive mental shift.
Huge.
So under $500,000, you can keep it simple. Just watch the bank account. What happens when you cross the line?
That puts you in the medium tier. So revenue from $500,000 up to under $3 million. Suddenly, you must have your financial report either reviewed or fully audited by a professional.
No exceptions.
No exceptions.
Yeah.
And you are legally required to use that complex accrual accounting system. And then, if you hit the large tier, so that's $3 million or more, you must be fully audited, full stop.
So let's walk through how this size creep actually happens in the real world. You've got a charity that's been comfortably small for a decade. Let's say they usually bring in, I don't know, $350,000.
A very typical size.
Right. They use cash accounting. But this year, they run an unbelievably successful fundraising gala, and they land a massive new state government grant. Suddenly, by May, they've pulled in $550,000.
And here is the terrifying part about that. They cross that $500,000 line without anyone realizing what it actually means.
Yes, they're probably thrilled.
The board is literally popping champagne because they can finally fund that new community outreach program. But legally, they just triggered an unbudgeted obligation to hire an auditor.
Oh, no.
And they're suddenly required to change their entire accounting basis to accrual.
It's not just outgrowing your clothes. It is like your internal metabolism completely changed, but you didn't change your diet, and now your vital organs are shutting down.
That is a great way to put it.
You've got all this new revenue muscle, but you're still walking around with the administrative skeleton of a tiny startup. Why does the government suddenly care so much more right at the $500 K mark?
Because $500,000 represents a serious level of public trust. You are likely employing staff now. You're handling substantial donor money. The government steps in and basically says, we need an independent set of eyes to verify you aren't mismanaging this.
Which is fair.
It is. But because volunteers are so hyper-focused on the mission, they completely miss the threshold.
Yeah.
By the time they realize that the financial year is already over.
Oh, man.
And then they have to try and retroactively convert an entire year of messy cash spreadsheets into an audited accrual report. It is an absolute nightmare.
How common is it for organizations to cross that line without anyone noticing?
Unbelievably common. It happens every single day, which is why you have to check those thresholds constantly.
So the key takeaway here is you have to actively monitor those ACNC thresholds every single year. You cannot let sudden success blindside your back office.
Exactly.
Okay, so let's say the board realizes they've hit that $500 K mark. The panic subsides, they bite the bullet, they hire the auditor. When that auditor actually arrives and opens the books, what are they hunting for? Because I imagine they aren't just like checking your arithmetic.
No, they are hunting for systemic weaknesses. The Trinity briefing outlines the anatomy of an audit failure, and they look for recurring preventative issues. And the absolute #1 finding in small to medium not-for-profits is poor segregation of duties.
Segregation of duties. Break that down for me in the context of a tiny team.
Let's invent a scenario. You have a long-serving, deeply dedicated office manager. Let's call her Betty.
We love Betty.
Everyone loves Betty. Now, Betty raises the invoices. She loads the payments into the banking system. She approves those payments. She takes the cash donations down to the bank. And at the end of the month, Betty reconciles the bank statements.
Okay, I have to push back here on behalf of every volunteer board out there.
Go for it.
If you're listening and you're on a board, you might be screaming at the radio right now. We barely have enough people to run the charity. On a tiny team where everyone is stretched thin, isn't it just basic efficiency for Betty to do everything end to end? Why is the auditor treating Betty like she's running a cartel?
What's fascinating here is that the auditor does not suspect Betty of stealing a dime. This is the single biggest misconception about audits.
It's not about catching a thief.
No, it is not about suspecting bad intent. It is about the absolute lack of a structural safety net. If Betty makes a completely innocent data entry error-like, she just adds an extra zero to a supplier payment. There is literally no one else looking at that transaction to catch it.
It's just a typo.
A very expensive typo. Or worse, what if Betty's email gets compromised by a phishing scam and a hacker changes the supplier's bank details?
Oh. Because Betty has the power to both enter the payment and approve the payment, the hacker can drain the account before anyone even notices.
Precisely.
It's like needing 2 keys to launch a missile. If you give both keys to Betty and someone steals Betty's lanyard, the missile fires.
Exactly. It is the two-key system. To an auditor, relying entirely on Betty being perfect and perfectly secure is a glaring control weakness. And the beautiful thing is, the fix doesn't require hiring more staff.
Really? How do you fix it with no money?
You just split the steps. Betty can load the payments into the banking software, but a volunteer board member has to log in from their own phone to hit the final approve button. You have instantly segregated the duty.
That makes total sense. It protects the organization, but honestly, it protects Betty, too. You never want to be the only person responsible when money goes missing.
Exactly. It takes the pressure off her.
So beyond the Betty scenario, what else is the auditor finding?
Weak documentation. Auditors operate strictly on evidence.
Yeah.
If your charity claims it brought in $50,000 from a fundraising drive, but the auditor can't trace that income back to original source records, they cannot form an opinion.
They need the receipts.
Literally. If expenses are missing receipts or don't have documented approvals from a manager, there is no paper trail. And if there is no paper trail, a qualified audit is almost guaranteed.
And I imagine cash is the absolute worst offender here.
Cash is the Wild West of accounting. Many not-for-profits still rely heavily on cash raffle tickets, sausage sizzles, collection tins. The problem with cash is it leaves zero digital footprint until it hits the bank.
Right. If someone drops a $20 bill into a bucket, the auditor has no way of knowing it was ever there unless it gets deposited.
Precisely. Which is why auditors insist on strict cash controls. You need dual counting.
Meaning two people count it.
Yes, meaning two people sit in a room and count the cash together, signing a piece of paper confirming the total. You need immediate receipting and prompt banking. If a charity is leaving a lockbox of cash in the trunk of someone's car for 3 weeks before banking it, the auditor will flag that immediately.
Yeah, that sounds like a disaster waiting to happen. Okay, so we've covered things like segregation of duties and cash handling, which honestly could apply to a small for-profit business too.
True.
But the source material highlights a pitfall that is uniquely dangerous for charities, like a trap that regular businesses literally never face. And that is the strings-attached nature of not-for-profit money.
Yes, the mismanagement of restricted funds. This is where so many well-meaning boards just completely fall apart.
Why is it so hard?
Because when a charity receives a major grant or a philanthropic donation, it very rarely comes as a blank check. It comes with strict rules. It must be spent on a named program within a defined time frame, and often any unspent money must be legally returned to the funder.
Okay, let me try an analogy here to make sure I'm getting this.
Go for it.
It's like someone giving you a stack of gift cards specifically for groceries, but you just toss them into a giant jar on your kitchen counter, mixed in with your movie theater gift cards and your coffee shop cards.
I like where this is going.
You just grab a card whenever you leave the house. A year later, the person who gave you the grocery cards comes back and says, "Show me the grocery receipts for my specific cards." You stare at the jar, and you have absolute no idea which card paid for what.
That is exactly what happens. And the accounting equivalent of that giant jar is a single, undifferentiated operating bank account.
So a charity gets a $50,000 grant for, say, a youth mental health program, and they just dump it into their main bank account where they pay their rent and their electricity.
Yes. They pool the funds, and the moment they do that, the math breaks.
The math breaks.
Yeah, they can no longer mathematically demonstrate to an auditor that the specific $50,000 grant was used exclusively for the mental health program, rather than, say, accidentally subsidizing the CEO's salary.
And the auditor has to report that.
They have to, because it is not just an accounting error, it's a potential legal breach of the funding contract.
Yikes. So what's the fix?
The only fix is that you have to track restricted funds entirely separately in your accounts from day one. Some organizations literally open separate bank accounts for major grants just to keep the audit trail pristine.
Which brings up a really crucial question. We started this deep dive in a board meeting where everyone is shocked by the auditor's findings. Where on earth are the directors in all of this? Don't they have a responsibility to catch this stuff before the auditor shows up?
They have the ultimate responsibility. And that brings us to the final major governance gap: board oversight that is just far too light. Directors will often sit in front of an auditor and say, well, we trusted the treasurer, they're an accountant, we just let them handle it.
Trust is a warm, fuzzy feeling. It is not a financial control mechanism.
Exactly. The source material is adamant about this. Directors must leave visible, documented evidence of their skepticism and scrutiny.
Documented skepticism.
Right. If the board meeting minutes just say, financial report tabled and approved, and they don't show that the board actively interrogated the numbers or asked questions about restricted funds, the auditor views the board itself as a governance weakness.
Wow. Okay, so we've mapped a minefield here. We know the traps, size creep, the Betty problem, pooled restricted funds, a passive board.
It's a lot to navigate.
It is. But let's raise the stakes for a second, because if you are a tired volunteer, you might hear all this and think, okay, so the auditor yells at us, writes a stern management letter, we promise to do better next year, no big deal. But what actually happens if an organization just ignores the auditor, or worse, completely fails to file their paperwork?
The briefing gets very, very real about this. It introduces the Annual Information Statement, or the AIS. This is the central annual report that every registered charity must lodge with the ACNC. And if you are a medium or large charity, your audited financial report has to be attached to it.
Here's where it gets really interesting and honestly quite terrifying, because the penalty for ignoring this isn't just a slap on the wrist, right?
No, not at all. If you fail to lodge your AIS 2 years in a row, the ACNC has the power to simply revoke your charity registration.
Revoke it entirely, like just wipe them off the map.
Yes, and let's slow down and trace the domino effect of what that actually means, because it is catastrophic.
Okay, walk me through it.
First, the ACNC revokes your registration. Because you are no longer a registered charity, the taxation office immediately strips away your charity tax concessions. And critically, you lose your deductible gift recipient status, your DGR.
Let's make sure we clearly understand DGR. That's the status that allows a donor to claim their donation as a tax deduction at the end of the year, right?
Exactly. It is the absolute lifeblood of fundraising. The moment you lose DGR status, imagine the phone calls you have to make.
Oh, man.
You have to call your major corporate sponsor who gives you $100,000 a year and say, hi, we lost our DGR status, so you can't write off that donation anymore.
That sponsor is gone. They will pull their funding immediately and give it to a charity where they get the tax break.
Exactly. The philanthropic foundations, gone. The high net worth individual donors, gone. An entire financial foundation is quietly dismantled.
And it didn't happen because of a scandal.
Right. It didn't happen because of a scandal on the front page of the newspaper. It didn't happen because the charity stopped rescuing animals or feeding the homeless. It happened over a diary discipline.
A diary discipline?
They literally just forgot to upload a PDF form 2 years in a row.
It is genuinely heartbreaking to think about a vital community service being wiped out just because a volunteer board didn't put a recurring calendar invite in their phones.
It happens.
Yeah.
And the tragedy is, it is 100% avoidable.
So we've spent a lot of time in the dark here. You know, the ripped cans, the lost grants, the revoked registrations. If you're listening, it is very easy to view governance and audits as purely defensive. It feels like a chore, a bureaucratic headache you endure just to keep the government off your back.
Sure, feels like compliance.
But the briefing from Trinity Accounting Practice offers this incredible pivot. They reframe audits not as a punishment, but as a superpower. They call it the transparency dividend.
This is perhaps the most crucial mindset shift a not-for-profit board can make. Strong financial governance isn't just about survival, it pays a real dividend.
Oh, so?
Well, in the not-for-profit sector, transparency is your currency. Funders, major donors, and government grant makers are increasingly risk-averse. They're terrified of giving money to an organization that might end up in the news for mismanagement.
Nobody wants their name attached to a mess.
Exactly. They want to see clean, audited accounts before they will even consider writing a check.
So instead of looking at the auditor as like the school principal coming in to check your homework and give you detention, you should look at the auditor as your marketing department handing you a verified 5-star review.
If we connect this to the bigger picture, a clean audit isn't just a compliance exercise. It is a credential. It is a badge of trust. You take that unqualified audit and you put it on the front page of every single grant application. You slide it across the table to every major donor.
It is the ultimate proof that you are a safe pair of hands. Think about it. If I am a philanthropic foundation and I'm deciding between 2 charities to give $1 million to,
Okay.
Charity A has messy cash handling, a passive board, and they pool all their restricted funds into one giant jar.
The grocery cards mixed with the movie cards.
Right. But Charity B hands me a crystal clear, unqualified audit showing exactly where every penny went last year, down to the cent. It is not even a contest. I am giving the money to Charity B.
Hmm.
In that scenario, the cost of the auditor literally pays for itself 10 times over.
Precisely. When you treat good governance as a fundraising asset rather than an administrative burden, the entire culture of the organization changes.
It stops being a chore.
Exactly. The board stops dreading the audit. It becomes an annual health check that mathematically confirms your competence to the outside world.
So let's bring this all together for you, the listener. Let's recap the core survival guide we've pulled from this source today.
Sounds good.
First, know your size. You have to check your revenue against those ACNC thresholds, the $500K and the $3 million marks every single year, so you aren't blindsided by an obligation to switch to accrual accounting.
Second, segregate your duties. Remember the two-key system. Do not let one person, no matter how deeply you trust them, control a transaction from end to end.
Third, treat restricted funds like radioactive material. Keep them tracked entirely separately from your operating cash so you can always prove exactly how they were spent.
And finally, never ever miss your annual information statement lodgement. Set calendar alerts for the entire board if you have to, because losing your DGR status is fatal.
And it is worth noting that the authors of this briefing, Trinity Accounting Practice, explicitly point out that they provide virtual CFO services to the not-for-profit sector to help organizations build exactly this kind of structural readiness.
It's a highly practical application of the systems thinking we've been discussing today.
It really is. It takes the pressure off the volunteers, it stops them from having to pretend to be accounting experts, and lets them get back to the actual mission they signed up for in the first place.
Which is the whole point.
Exactly. But as we wrap up this deep dive, there's one final piece of this puzzle that really sticks with me. We talked about the transparency dividend, how a clean audit is actually a credential for growth.
Yes, audits as marketing.
Right. And it leads to a rather provocative question about how we fundamentally run these organizations.
It raises a profound question indeed. If a clean audit is actually a powerful fundraising asset, as the source suggests, shouldn't not-for-profits stop viewing the board treasurer role as just a back-office compliance job?
Oh, that's a really interesting point.
We usually just recruit whoever is willing to do the math, right?
Right.
But if pristine financial reporting is the exact key that unlocks the biggest government grants and the major philanthropic donors, perhaps the treasurer is actually the most important marketing executive the charity has. And if that's true, we might need to completely rethink how we recruit, how we value, and how we support the people who manage our organization's finances.
That is a phenomenal point to end on. It is not just about counting the money. It is about telling a bulletproof story about the money in order to unlock more of it. Thank you for joining us on this deep dive. Keep asking the hard questions, keep checking those size thresholds, and we will catch you next time.